You're a 72-year-old widow in Ohio. Your husband passed away a little over 2 years ago. You've grieved. You've adjusted. You've figured out how to run a household on one income instead of two. And then one day, an envelope shows up from Medicare. You open it, expecting the usual. Instead, you see your Part B premium just jumped from $202.90 a month to $405.80 a month. Overnight. No warning, no life event you can point to that just happened. Your income barely moved. So what on earth is going on? Here's the thing. This isn't a billing error. This isn't a scam letter. This is a feature quietly built into the Medicare system, and it is about to hit hundreds of thousands of surviving spouses over the next decade, and almost nobody is talking about it. I want to walk you through exactly what's happening here, why it happens, why the usual fix doesn't work, and what you can actually do about it before it's too late. Because if you've got a spouse and your household income is anywhere close to a certain number, this is one of those things you really want to see coming before it punches you in the face. Hello, I'm Anne. Welcome to my channel. This video is for educational purposes only and does not constitute legal, tax, or financial advice. Let's get into it. So first, let's talk about what's actually doubling here. It's something called IRMAA, the Income-Related Monthly Adjustment Amount. Ugly acronym, I know, but stick with me because once you understand this one concept, the whole story clicks into place. Medicare Part B, the part that covers doctor visits and outpatient care, has a standard premium that almost everybody pays. But if your income is above a certain threshold, Medicare tacks on a surcharge. The higher your income, the bigger the surcharge. That's IRMAA. It's been around for years, and honestly, for most people, it's a total non-issue. Only about 8% of people on Medicare Part B ever pay an IRMAA surcharge at all. So if you're sitting comfortably below these thresholds, what I'm about to tell you doesn't apply to you, and you can relax. But here's where it gets interesting, and where almost nobody sees this coming. The income thresholds for IRMAA are different depending on whether you file your taxes jointly or as a single person. For 2026, a married couple filing jointly can have a modified adjusted gross income of up to $218,000 and pay zero IRMAA surcharge. Zero. Nothing. You're under the radar. But a single filer? Their threshold to stay surcharge-free is just $109,000. Now look at those two numbers for a second. $218,000 for a couple, $109,000 for one person. That's not a coincidence. It's almost exactly half. The IRS and CMS basically built every single IRMAA tier as roughly double for couples what it is for individuals. Makes sense on paper, right? Two people, double the threshold. Except here's the trap. When one spouse dies, what doesn't get cut in half? The income. The Social Security checks don't suddenly shrink by half. The pension doesn't cut itself in half. The required minimum distributions from the IRA keep flowing at the same rate they always did. The income largely survives intact, but the bracket the survivor gets measured against, that collapses instantly by half. So you've got a household income that didn't change getting slammed up against a threshold that did change dramatically just because of a change in filing status. That's the whole trap in one sentence. The income stayed the same. The yardstick got shorter. Let's make this real with actual numbers because this is where it stops being theoretical and starts being scary. Imagine a couple, let's call them Bob and Carol, bringing in $160,000 a year combined, 2 Social Security checks, a modest pension, some required minimum distributions from an IRA. Totally normal, middle-class retirement picture. At $160,000 joint income, they are comfortably under that $218,000 joint threshold. They pay the standard Medicare premium. No surcharge, no drama, life is fine. Then Bob dies. Carol keeps the larger of the two Social Security checks because that's how Social Security survivor benefits work. You get to keep the higher one, not both. She keeps the pension's survivor benefit. She keeps the IRA. And those required minimum distributions don't stop just because Bob's gone. If anything, depending on the account, they can even accelerate. Add it all up, and Carol's income comes out to roughly $150,000 a year as a single filer. Now remember, the single filer thresholds are roughly half of the joint ones. At $150,000 of single income, Carol isn't just over the line. She's solidly into the second IRMAA tier, the bracket that kicks in above $137,000 and runs up to $171,000. Her Part B premium jumps from the standard $202.90 a month to $405.80 a month. That's literally double. And it doesn't stop there. Her Part D prescription drug coverage tacks on another $37.50 a month in surcharges too. Add it up, and Carol is now paying an extra $240.40 every single month, or just over $2,884 a year, for an income level that she and Bob together paid absolutely nothing extra on. Same dollars, completely different bill. Just because the household went from 2 people to 1. And here's the part that really stings. This hit doesn't even show up right away. Medicare premiums run on a 2-year look back. Your 2026 premium isn't based on your 2026 income. It's based on your 2024 tax return. Specifically, line 11 adjusted gross income plus line 2A, your tax-exempt interest. Yes, even municipal bond income. The stuff that feels tax-free because, well, it kind of is for income tax purposes, still gets counted here. So Carol's higher premium doesn't even show up immediately after Bob passes. It shows up 2 years later, almost like a delayed reaction, right when she's settled into her new normal and stopped expecting any more financial surprises from this. That delay is exactly why so many widows and widowers get blindsided. By the time the letter arrives, the death itself feels like old news. So the connection between spouse passed away and premium doubled doesn't even register. It just looks like Medicare randomly decided to charge more. Now, naturally, your first instinct here is probably, okay, well, there's got to be a form for this, right? Something I can fill out to fix it? And yes, there is a form. It's called SSA 44, and it lets you ask the Social Security Administration to recalculate your IRMAA after what's called a life-changing event. Death of a spouse is literally on the approved list of life-changing events. So this should work, right? Here's the gut punch. The form only resets your IRMAA to the extent your income actually dropped. Read that again because it's the crux of this entire video. SSA 44 doesn't care that your filing status changed. It doesn't care that the bracket you're measured against just got cut in half. It only cares about one thing. Did your modified adjusted gross income go down? In Carol's case, her income didn't go down. The pension kept paying. The RMDs kept flowing. She's sitting at the same $150,000 she would have been at anyway, just now measured on the wrong-sized ruler. So when she files SSA 44, there's nothing for the Social Security Administration to undo. The bracket moved, the income didn't, and the form is built only to react to the income side of that equation. Most surviving spouses in this exact situation, the ones whose income mostly survived the death intact, simply do not have an appeal option. None. The form exists, but it has nothing to grab onto. And this isn't just a death of spouse problem either. The same exact logic blocks people who try to appeal IRMAA after something like a Roth conversion or a home sale. If you made a voluntary choice that bumped up your income, or if your bracket shifted purely because your filing status changed, the SSA 44 form simply was not designed to reverse that. It only works for things like, I retired and my income genuinely fell, or my spouse's spouse's pension income that I no longer receive genuinely disappeared. If the dollars are still there, the form is powerless. Now, let's stress test this with a second couple, because the size of this trap really depends on where your income sits, and I want you to be able to place yourself on this map. Take a different couple. Let's call them Frank and Linda. They're more conservative spenders, living on $130,000 a year combined, comfortably under that $218,000 joint threshold, with plenty of room to spare. No IRMAA worries for them at all, joint or otherwise. Frank passes away. Linda's income, once you account for losing the smaller of the two Social Security checks but keeping survivor benefits and the same RMD schedule, settles around $100,000 as a single filer. Now look at that against the single thresholds. $109,000 is the first line. Linda's at $100,000. She's still under it. No surcharge, joint or single. For Frank and Linda, the bracket shift that terrifies so many other couples simply doesn't bite, because there was enough distance between their income and the threshold to absorb the filing status change. Now flip it. Take a third couple, George and Patricia, living a bit further up the income ladder at $200,000 joint, still under the $218,000 line, still paying zero IRMAA as a couple. George passes. Patricia's single income comes out to $165,000. Look at the single brackets again. $109,000, $137,000, $171,000. She's landed right in that second tier, same as Carol from our first example, and her premium also roughly doubles. Notice what just happened here. George and Patricia were paying nothing extra as a couple, sitting $18,000 under their joint threshold, looking perfectly safe. And yet, the survivor still got pulled straight into a surcharge tier. That's the part that should make your stomach turn a little. Being comfortably under the joint threshold tells you almost nothing about whether the survivor will be safe. The only number that actually matters is where the survivor's income lands relative to the single thresholds. And that's a completely different calculation than most couples ever bother running. So here's the rule of thumb worth remembering. It's not your current joint income that determines your risk here. It's what your spouse's income would look like alone, measured against brackets that are half the size. Two couples can have the exact same joint income today and end up with completely different outcomes for the survivor, just based on how much of that income would carry over after one spouse is gone. And look, the timing on all of this could not be worse for a lot of households. The Bureau of Economic Analysis recently reported that the personal saving rate sat at just 3.7% in the first quarter of 2026. Compare that to 5.2% just 1 year earlier, in the first quarter of 2025. People's cushions are shrinking, margins are tighter, and into that environment, you're dropping a surprise $2,800 a year Medicare bill on someone who just lost their spouse and is already adjusting to living on one income instead of two. That's the cruelest part of this whole mechanism. It tends to land exactly when people have the least room to absorb it. So, okay, I know what some of you are thinking right now. Great, so I'm just stuck? There's nothing I can do? No, there's actually quite a lot you can do, but it all has to happen before the look back locks in, not after. This is a planning problem, not an appeals problem. Let's talk about what that planning actually looks like. First thing, map out the surviving spouse's projected income right now, today, while both partners are still around to do this kind of planning together. Sit down and add up what the survivor would actually receive if the worst happened tomorrow. The higher of the two Social Security checks, any pension survivor benefit, the RMDs that would keep flowing from retirement accounts, taxable interest, and yes, tax-exempt interest too, because that counts toward MAGI for this purpose, even though it doesn't count for regular income tax. Once you've got that number, compare it against the single filer thresholds, $109,000, $137,000, and $171,000 for 2026. If that projected number is sitting close to one of those lines, even a few $1,000s of room in either direction can mean the difference between paying nothing extra and paying thousands extra every year. This single exercise Just running the numbers, honestly, is the most important thing you can do, and almost nobody does it until the letter shows up. Second thing, and this one's clever, use the year of death deliberately. In most cases, the year a spouse dies is still filed as a joint return. The IRS generally allows you to file jointly for that final year. That means you're still operating under the bigger joint thresholds for that 1 year. If you know a death is approaching, or frankly, if you're just doing smart proactive planning while everyone's healthy, that joint filing year can be a strategic window. A Roth conversion, harvesting some capital gains, pulling forward some income you were going to realize anyway. These kinds of moves can sometimes fit comfortably under a joint IRMAA threshold that the very next year simply will not exist anymore for the surviving spouse. Once that filing status flips to single, that wider joint bracket is gone for good, and the survivor is permanently measured against the narrower single brackets going forward. So the timing of certain financial moves really does matter here, more than most people realize. Third thing, and this one gets overlooked constantly. Pay attention to required minimum distributions, specifically, because they're often the single biggest lever in this whole equation. Once you turn the age where RMDs kick in, the IRS forces you to pull a certain percentage out of your traditional IRA or 401k every year, whether you need the cash or not. And that withdrawal counts fully toward your MAGI for IRMAA purposes. For a couple, splitting retirement savings across two people's accounts effectively splits the RMD burden too. But once one spouse dies, if those accounts get inherited and consolidated, the survivor can sometimes end up taking RMDs based on a larger combined balance, which pushes MAGI even higher than it would have been otherwise. This is exactly the kind of thing worth modeling out with a tax professional years in advance, not scrambling to fix in the year it actually happens. Sometimes the smart move is starting smaller, strategic Roth conversions earlier in retirement, while you're both still alive and filing jointly, specifically to shrink the size of those future RMDs and reduce how hard the survivor gets hit down the road. Fourth thing, only file SSA 44 when there's an actual income drop to point to. If a spouse's pension simply stops because it didn't have a survivor benefit attached, or some other income stream legitimately ends with that person's passing, that's a real, genuine decrease. And that's exactly what SSA 44 is built for. Document it and submit the form within the same year that lower income begins. But, and this is important, don't file the form just hoping it'll somehow neutralize a bracket shift on income that hasn't actually changed. It won't work. It'll get denied. Save yourself the frustration and the false hope, and focus your energy on the planning side instead, where you actually have leverage. So let's bring this back to where we started. That widow in Ohio, the one who opened her envelope and saw her premium had doubled, she couldn't appeal it. There was no form, no phone call, no letter to the Social Security Administration that was going to undo what had happened. The bracket had shifted, and her income simply hadn't moved enough to give her any leverage to push back. All she could do, looking forward, was plan around the next bracket, the next decision, the next dollar of income she chose to realize or defer. And that's really the lesson hiding inside this whole story. This isn't really about Medicare being unfair or some bureaucratic glitch in the system. It's about the fact that nobody told these couples, while they still had time to plan, that the rules quietly change the moment one of them is gone. If you've got a spouse right now and your combined income sits anywhere within striking distance of that $218,000 joint threshold, even $20,000 or $30,000 under it, this is worth actually sitting down and running the numbers on, together, while you both can. Because the math doesn't wait for grief to pass. The 2-year look back doesn't care that you're still adjusting to a new reality. It just quietly does its thing in the background and shows up in an envelope when you least expect it. So do the math now. Map out what the survivor's income picture actually looks like. Talk to whoever helps you with your taxes or your retirement planning, and make sure this exact exact scenario is part of that conversation, because a lot of advisors honestly don't bring it up unless you ask. A few smart decisions made today, while you've still got the wider joint brackets to work with, can spare your spouse a surprise bill of thousands of dollars a year at the exact moment in their life when they'll have the least capacity to absorb it. If this was useful to you, share it with someone who needs to hear it, because chances are you know a couple right now who has no idea this is coming for them.